The fourth component cost of capital that we're going to talk about is retained earnings. Now you'll recall from an earlier video now, retained earnings is part of equity. This is owner investment in the company. Now you have owners who, instead of taking the money out in dividends now, are reinvesting the money. Now, in a cost of capital sense now, the question really is, what would the owners do with the money if, instead of retaining it, they took the money out? What would they invest in? Of course, some people would invest in real estate, some people invest in bonds, some people invest in preferreds. You just don't know. To simplify that now, we assume that if the owners got the money now, what they would do now is they would invest the money back into the common stock of this company. Now, because of that now, retained earnings is said to be an opportunity cost. This is the rate of return that the owners miss out on by reinvesting the money, by not taking the money and investing it somewhere themselves. So retained earnings now is looked at as the owner's opportunity cost. These are the funds that they don't take out in dividends, that they don't take themselves, but rather reinvest in the company. And again, it's an opportunity cost. Now, what we assume here with retained earnings is that if the owners had the money, if they took the money out themselves, they would take the money and they would reinvest it into the stock of the company itself, the common stock. And if they did, they would pay this price, the price of the common stock in the market. And if they bought this common stock today, they would get the next dividend, D1, plus they would get this growth rate over here, sort of a capital gains rate on the money. That's the component cost of capital for retained earnings. It's D1, the dividend, the common dividend you expect one time period from now, divided by the price of the common stock in the market, plus the growth rate. And in financial theory, this is looked at really as the owner's opportunity cost by reinvesting money, by retaining money into the company. So the numerator is the common dividend you expect one time period from now. P sub CS, that's the price of the common stock in the market. And G, that's the growth rate you expect. Again, some people use the internal growth rate, some people use some expected capital gains rate, but it's viewed as the growth rate in the stock. As an example here, this is the same example we used, same numbers we used from the common stock component cost of capital. You have a stock whose current dividend, D0, is $3. You have a common stock that's currently selling in the market for $35 a share, and you have an expected growth rate of 6%. So to get D1 now, we're going to multiply the current dividend, $3, times 1.06, 1 plus the growth rate. And that gives us the expected dividend, the dividend we expect one time period from now, to be $3.18. We're going to divide that by the price of the common stock in the market, which is $35, and we're going to add to all of that the growth rate, in this case 6%, 0.06. If you do that, you get 0.1509 in your calculator, which is the decimal equivalent of 15.09%. So we would say that this company's component cost of capital for retained earnings is 15.09%. This is the rate of return that we think owners would get with their money if we gave it to them and they invested it themselves. This is their opportunity cost. Again, the component cost of capital for retained earnings, 15.09%.